$25 billion in 30-year US Treasury bonds hit the auction block on Wednesday, and for the first time since June 2007, the US government had to pay above 5% to find buyers willing to absorb that paper. The high yield cleared at 5.046%, breaking through a level the bond market has not seen in 19 years. Pretty damn long time. The last time long bonds demanded that much compensation, 15 months later, Lehman Brothers collapsed and the global financial system went through the floor. That was the GFC. You may have heard about that one. The equity market is sitting near record highs, pricing essentially none of it. The bond market is screaming the truth. So today I'll walk you through exactly what broke at this auction, why Japan and the UK are flashing the same red light at the exact same moment, why 2007 parallel is far cleaner than anyone wants to admit, and where this whiplash sits inside the 18-year cycle. Let's hit that like button, subscribe to the channel, go on the journey together. And if you want the full framework on the 18-year cycle, the free 3-part mini course, there's a link in the top of the video description for that. We'll cover the auction, the global contagion, the 2007 mirror, the smart money positioning, and the cycle stage we're sitting in right now. So let's just get straight into the data. It was May 13th, 2026. The US Treasury auctions $25 billion in 30-year bonds. The high yield clears 5.046%. That's the first 30-year auction above 5% since June 2007. By the close on May 15th, the secondary market had already pushed the same bond to 5.12%, the highest reading in 19 years. The bid to cover ratio came in at 2.3, which is described across multiple desks as below average demand. So the translation is the buyers showed up, but they made the Treasury pay through the nose to absorb the supply. Bank of America put it perfectly this week. They called the 5% level a psychological line that reminded clients that historical booms and bubbles, and I'm quoting them directly, often end with a sharp jump in yields. What are they saying? There's a boom and a bust happening? Seems like it. Now stack the rest of the curve next to that. The 10-year is sitting at 4.57%, the highest reading since May of last year. The 2-year is back above 4% at 4.07, which is now trading above the Fed funds rate of 3.5 to 3.75. Remember the interest rate pause that we saw the other month? When the 2-year exceeds the funds rate, the bond market is telling you the Fed is behind the curve on inflation. Enough said. And the data underneath supports that move. April headline CPI printed at 3.8% year over year. That's the highest reading since May 2023, so 3 years ago. April PPI ripped to 6% year over year, the highest since January 2023. So we're seeing everything increase at this point. The monthly PPI jump alone was 1.4%, the largest single month print since March 2022. Now, if you bring it back to the household level, Freddie Mac's 30-year fixed mortgage rate is sitting at 6.36% for the week ending May 14th. The national median existing home price just printed $418,000. A 20% down payment at current rates produces a monthly principal and interest payment of roughly $2,100, which is consuming about 24% of the median family income before insurance, taxes, before any other line item that actually crushes the household budget. Obviously, it's unsustainable. And here's the part that almost nobody on financial TV is saying out loud. They never say a lot out loud, do they? They say a lot, but they don't say much at the same time. The US national debt is sitting at roughly $40 trillion. Well, they've said that before, but they haven't said this. The Treasury is paying nearly $3 billion US a day in net interest right now. $3 billion every single day just to service the debt. Now, it does sound like a lot of money, but can we afford to keep paying that? Every additional 100 basis points on the average yield adds roughly $400 billion a year to that interest line. And this isn't just an American story about an American deficit, because the same week the 30-year auction broke 5%, every other major sovereign bond market on the planet was flashing the exact same red light. Start with Japan. The Japanese 10-year JGB just hit 2.73%. That's a 29-year high, the highest reading on the Japanese 10-year since May, get this, 1997. 1997 was also the year the Asian financial crisis cracked open and the global liquidity went into hiding. But it gets sharper. The Japanese 30-year JGB just breached 4% for the first time since the tenor was launched back in 1999. That is a true all-time high for that maturity. So the 20-year JGB climbed to its highest level since 1996, sitting around 3.61%. The entire Japanese yield curve is at a multi-decade extreme simultaneously. And here's what matters globally. Japan is the largest foreign holder of US Treasuries on the planet, sitting on roughly 1.24 trillion US dollars on paper. When Japanese yields rise, Japanese institutions don't need to hunt for yield in New York anymore. They sell US Treasuries, bring home that capital, and obviously get the interest rate back home. That is a direct funding crisis for the US auction process, which is what we just walked through. Now, put the yen carry trade on top of all this. Remember back in August 2024? For decades, global hedge funds have borrowed cheaply in yen and parked the proceeds in higher yielding global assets, US tech, US Treasuries, crypto, you name it. So when the yen strengthens and the JGB yields rise, those traders are forced to sell global assets to repay their yen liabilities. That selling is fast and indiscriminate. We saw the preview in August 2024. The Bank of Japan delivered a surprise hike. The Nikkei fell 12.4% in a single session. That's the worst day since 1987. And Bitcoin collapsed from roughly 65K to 50K in a single week. The market is currently pricing a 74% probability of another BOJ rate hike by June. So basically, let's hike those interest rates in Japan. Now let's flip to the United Kingdom. The UK, your 10-year gilt is sitting at 5.165%. That's the highest reading since July 2008. Tough month, July 2008, basically right on that top. The UK 30-year gilt just hit 5.84%, the highest since 1998, and the 10-year has risen over 90 basis points since its February low. Bank of England policymaker Catherine Mann warned this week that overseas investors hold a record 33% of UK government debt, and in her words, are more likely to exit quickly during shocks. That's the bond vigilante structure rebuilding itself in real time. Now, widen the lens to the rest of the G7. French 30-year debt is at a 17-year high. Germany 30-year bonds are at 15-year highs. The implied yield on G7 sovereign debt at 10 years and longer just climbed above 4.6%. That's the highest aggregate reading since 2004. Four of the most powerful economies on the planet are simultaneously paying multi-decade highs to roll their debt. Tell me that's a coincidence. But, you guessed it, it gets worse. The last time the US 30-year cleared above 5% at auction was June 2007. So let me walk you through exactly what happened next. June 2007, the long bonds peaked at 5%. The bond traders started whispering about credit conditions tightening. 4 months later, October 2007, the Dow closes at its all-time high of 14,164. Equities are sitting at record highs while bonds are screaming danger. It's a textbook smart money signal. Institutions were quietly buying duration while retail was chasing the index into the top. Sounds a little like now. March 2008, Bear Stearns collapses. Now that's several months later from the top that we saw the collapse. Then 2008, Lehman files, and the entire global banking system seizes. That's roughly 15 months from the bond peak to the systemic collapse. By March 2009, the Dow is sitting at 6,500, about a 57% drawdown from the October 2007 peak. It took the S&P 500 until March 2013, that's 5.5 years later, to surpass its previous high. Stan Druckenmiller has been arguing this exact mechanism for 4 decades. Hopefully he hasn't been calling a recession every year, which we know he hasn't. The bond market leads the equity market by 6 to 12 months because the cost of long-term capital sets the discount rate for every leveraged asset on the planet. When that cost breaks structural resistance, the highly leveraged systems crack first. We know tops are a process, they're not a single event. The bond peak comes first, the equity peak comes second, the credit event comes third. That is the sequence in 2007, and that is the sequence we're sitting inside of right now. So now here's the part that worries me the most. In 2007, US debt to GDP was roughly 62%. Today it's sitting north of 122%. Investment grade corporate bonds are now yielding 6.5 to 7.5%, and that makes fixed income a direct competitive alternative to equities in a way it has not been since pre-GFC era. When the risk-free rate offers the same yield as the S&P 500's earnings yield, the equity risk premium effectively disappears and capital starts rotating out of equities by mathematical necessity. You're getting a better option somewhere else. This isn't an opinion, it's just maths. Now bring this all back into the framework. If you've been following the channel, you know we talk a lot about the 18-year cycle, originally documented by Fred Harrison, refined by Phil Anderson, and sourced from over 220 years of US public land sale data. Fred Harrison called the 2008 financial crisis as far back as 1998 in his book Boom Bust. He wasn't guessing, and he didn't call it every year. He had a specific date and said markets will go up into that date. He was basically reading the cycle. The cycle runs roughly 14 years up and 4 years down. The final 2 years of the boom phase is what Harrison and Anderson call the winner's curse. That's where speculation goes vertical. We've obviously seen that in the last few weeks with AI, right? That's where the credit costs explode. That's where buyers pay over asking, banks throw cheap leverage at every Tom, Dick and Harry, and government deregulate or inject liquidity to keep the boom alive a little longer. The price cycle's winner's curse phase lined up exactly with that 2006 to 2007 peak. The bond peak landed in June 2007. Equity, roughly October 2007. The systemic collapse in September 08. Right on schedule. Now let's look at the present cycle. This is post-GFC bottom in 2012. Mid-cycle slowdown around 2019 to 2020 with the COVID disruption. Boom phase from 2020 through to roughly 24. Winner's curse window, roughly 24 through to 2026, and the projected cycle to peak roughly in 2026. It's not a forecast that I'm making up. It's the maths of the framework drawn over 220 years of data pointing at the exact window we are currently sitting in. And the 30-year Treasury just broke above 5% for the first time since the last winner's curse phase. The Japanese 10-year just hit 29-year high. The UK 10-year just hit the highest level since, here we go, July 2008. The G7 aggregate yield just broke above 4.6%, the highest since 2004. 3 confirmation signals all firing roughly around the same time through the cycle with the framework that was forecasted. Credit expansion, land speculation, leverage, complacency, and the inevitable repricing. If you want the full breakdown on how this stage 5 into stage 6 transition fits into the broader 18-year cycle, the 7 stages of the model, and how to position for what comes next, I put together a free 3-part mini course that walks you through all of it. Part 1 is the cycle itself and the 220 years of data behind it. Part 2 is exactly where we sit right now in the timeline. And part 3 is how we're positioning for that rollover. Completely free, link in the top of the video description. Now I want to hear from you. After everything you just heard about the 30-year breaking 5%, the 29-year high in Japan, the UK gilt parallel to July 2008, and the bond market refusing to fund the deficit at a discount, where does this all resolve? Does the US Treasury market force the Federal Reserve back into a liquidity facility within the next 6 months as yields keep grinding higher? Or does Japan crack first with the BOJ hiking, the carry trade unwinding or continuing to unwind, and the global liquidity drain pulling US assets down with it? Drop your call in the comments section. I'll be reading every single one of them and replying to as many as I can. Hit the like button, subscribe to the channel, and grab your 18-year cycle mini course. Links in the top of the video description. I'll see you guys in the next video. Until then, take care and peace out.